Welcome back. Well, you're tuned in Closing Bell. You're on CNBC-TV18. Well, we've been discussing the markets, and to help us out with that, we have Dinshaw Irani, Chief Investment Officer at Helios Capital India, who joins us on the show. Hi, Dinshaw. Thanks so much for joining in. Well, the consensus seems to be leaning towards the large caps, and maybe some part of the mid-cap and small-cap indices, well, they are looking a little bit frothy. Do you believe so? Or do you still cite that maybe there are still plenty of opportunities? You'd rather go with the mid and the small caps?
Nigel, thank you for having me on your show, and a very good afternoon to you, your team, and the viewers. So, Nigel, basically, I think the excesses which are getting corrected now, I think the market was waiting for 20,000 for the narrower indices, the broader indices rather, to start collapsing per se. But we always felt that, actually, Nigel, that things were very frothy, especially in the mid-cap space, because mid-cap, unfortunately, are limited to 150 stocks, right? And the way the money was flowing in, there were only these 150 where anyone could have invested as such. So that space had become highly frothy. In the smallest cap space, unfortunately, the money was flowing to funds which are only concentrating only on the index-specific small caps, right? But however, the small cap, it's an ocean. Anything beyond 250 is a small cap. So you could have very well dug a bit deeper and got good values as such. I think that's where the value lies today, beyond the index. But obviously, the way the money was flowing into these the sector-specific stocks, rather in mutual funds, that's why you're seeing this kind of frothiness in the index-specific stocks as such. So I would rather stay away from the mid caps. Small caps, still there's a lot of flavor left.
A lot of flavor left in the small cap universe. That's interesting. Do you want to elaborate a little bit more?
Yeah, as I said, the fact is that most of the small cap mutual funds, which have become really large now, 30, 40,000 crores in small cap mutual funds, particular schemes, obviously they don't have much choice. They're only investing in the small cap space, which is in the index, the stocks which are in the index. But if you go beyond that, you have enough and more to invest in. Like, for instance, we got a few small caps which are at 12, 13 Ps in our portfolio. Obviously, our analysts are doing much more, sweat work to find out these names for us as such. So there is comfort there. But as I said, that if you look at, obviously, index-based small caps, you're in for trouble. I think that story over there is overdone.
Okay, Dinshaw, hi, good afternoon. Interesting, at least you're, you're still looking at that part of the market, because otherwise it's, people are just wondering what to do, what to sell, whether to stay on. So, okay, let's talk overall. If someone is looking at the rally and, suffering a bit of a FOMO and wondering whether this is the time to deploy, what would your advice be? I know wisdom is that never time the markets, but in general, because we also have a lot of events coming up, right? We have the inflation print. Today we'll get the CPI numbers for India, then we get the US inflation numbers. Go on and look at more macros. And then obviously over the next 6 months, we're running into elections. There's a lot that's going to happen. So how should you go about making fresh money allocations in this market now?
So here's how we look at it. By the way, let me just clarify. As I said, that small caps are anything beyond 250 stocks. The top 250 stocks are small caps, right? So there's enough. It's like an ocean. So you have enough ideas if you can work harder and take out those ideas. That's why I'm saying that the space beyond the index looks very good, right? Not within the index. So that's one clarity I want to bring in. Apart from that, the good thing that we take away from the market today is, despite crossing 20,000, which is an all-time high as such, the fact is that the valuations are still in sync with history. If you look at, we've always been promoting the fact that you should look at only the valuations post Demon, because after that only the real culture caught on, equity culture caught on. So if you look at that post Demon, I think the valuations were something like 19 and a half times 1 year forward. And today we are at 18 and a half times. We're talking about the narrow index right now, which is Nifty 50, where it's around 18 and a half times forward index. So I don't see that part to be frothy. I think there's enough options available in the large cap space where you can look at. And plus, obviously, when an investor comes to us, since we are a mix of, we don't like a flexi cap, our PMS and the AIF offering is a flexi cap kind of offering. We always say and tell them that, why don't you stagger your investment? look at it over 5 months, because by then you'll have all these problems that you stated out of the way for us. So it's better to stagger it across, as you rightly stated. You cannot time the market, but we are very comfortable with the fact that in the next 5 years, you see a secular growth story in our country. And obviously, in our minds, we're looking at a mid-teens kind of CAGR for the next 5 years in the index per se. So you don't want to miss that out. So just stagger it across, average out, and play the market that way.
Time for, Dinshaw, hi afternoon, time for HDFC Bank and the likes to start to get some interest?
I think so, Prashant. The fact is that these two guys, I mean, the banking sector per se has been a total laggard. If you see the rally which has happened especially in the large cap portfolios as such. So banks per se, I think, is on the way up. And if anything, HDFC Bank being the probably the biggest guy who hasn't performed much, I think it's a time for him to start rallying. Overhang, obviously, it did start moving up, but an overhang came by way of RBI imposing that additional 10% CRR on these guys. But I think that is now out of the way. You know the flight path for that as such, and I think that hurdle is out of the way. So looks like good. Growth should be a problem on the asset side. It's more of the liabilities that they have to manage, and I think they're doing a good job there.
Okay, Dinshaw, let me come back to the statement that you made because we're not finding too many people who are sticking their neck out for small caps and mid caps right now. So I'm going to come back to that. So, tell us some themes and ideas, because I remember our past conversations. I mean, you've been cautious on consumer. You've been looking at IT, also with a fair amount of sort of caution, but stocks have already run up. CapEx, I don't even know what to say. PSUs, I know you've never liked PSUs, you've not been holding PSUs. So what beyond the mid-cap and small-cap index per se?
Okay, now the mid-cap, as I told you, it's 150 stocks, so avoid those, okay? That's what we've been looking at avoiding. In fact, we've been constantly probably, trimming our names in the mid-caps. We also are comfortable with the kind of valuations that are there. In the smaller cap space, you have enough consumer names. You have stories like the auto space, auto ancillary space, where you can work around, where they're niche pairs, right? So as I told you that we have a particular stock which is a 13 PE, and obviously that's in the auto ang space, and it's a purely an outsourcing story. He's got this massive market share in whichever segment that he's in. I won't name the segment because you'll be able to make out what I'm talking about. So that's how you dig around and you look at stocks there. Obviously, there are limited stories there, so you have to be very careful. But one thing that we're very clear about is that the growth has to support this kind of valuations per se. So if there is growth built in there, that is what we are looking at, and at obviously reasonable valuations. So we are probably growth players at reasonable value as such. So that's how I would put it.
Dinshaw, out of time. Thank you very much for joining in today. As we slip into a break, here is